If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Multifamily Monday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What's going on, everybody? You know the deal. Every Monday, we're coming at you with all things multifamily investing, from how to find a deal, how to take it down, how to finance it, how to operate the deal, how to exit the deal, and then rinse and repeat. So all things. But before I get into that, you know the fee. If you get value out of the show, please share it with someone who you think could also get value out of the show. It could be a friend, family member, colleague, maybe just some random acquaintance. Share it with them if you think they can get value. Share it on your social. Be much appreciative. And if you haven't already done so, please leave a rating and review on Apple Podcasts. That really does help us. All right, everybody. So today we got a great guest, a friend of mine. His name is Paul Winterowd. He is a mortgage broker. So we talked all things lending perspective when it comes to multifamily investing. Kind of talk about, the heyday of 2021 and now what the landscape looks like in, midway through 2022. A lot has changed. Rates have gone up. The appetite from lenders has, pulled back. And so we get into a lot of things, what to look for, what lenders are looking for, how to work with a broker like Paul, like what he looks for in investors, and how to work efficiently with him. And we just talk about the asset class in general and why we think, it's just a great place to be. And yeah, there's a little turbulence right now, but in the long term, we both agree that it's the place to be and not to really ever stop buying. It's just in times like this, you got to be smart on how you buy. And you got to be creative. There's still deals out there and you still can take them down. It's just going to take a little bit more of creativity than it has in the recent past. So we talk a lot about that, but this is a really good show. It's on the longer side, but that's for a reason. We talk about a lot of good stuff. So this is one you're definitely going to want to listen to. But without further ado, here is Paul. Hey, Paul, welcome to the show, my friend.
Shawn, good to reconnect.
Yes.
Hopefully, here.
Yeah, thank you for joining. I know you're a busy guy, so I appreciate you taking time out of your day. And hopefully next time we can actually connect in person. I do plan on coming out west to ski, so hopefully we can get some skiing in next year.
Well, good. I'm planning on coming to the Northeast to play some golf. So maybe we can.
When is that?
Soon. Hopefully next summer. Or fall.
Oh, let's do it. Yeah, I've got some great courses to show you. If you're not too full, we could definitely play. So that'd be great.
Awesome.
But yeah, let's just get right into it. Everyone loves a good origin story. So who's Paul and what do you do?
Yeah. It's been a journey. I've been like full-time immersed in commercial real estate, primarily multifamily, but in some other assets as well. This would be my 8th year. I've been in the business. I'm kind of middle of my career, hopefully. A golf analogy. I'm not sure if I'm still on the front nine or back nine, but I'm 45, and hopefully on the front nine for a couple.
I think you're on the front.
But we chatted about golf, and that was important to me. I actually played golf in college, and it was very apparent to me that if I was gonna make that my career, I'd be eating rice and beans for the most part. I played in college, but it was clear I had to figure something else out, and I never really knew what I wanted to do. I'd always had this latent interest in real estate. In fact, the first thing I did after I got my undergrad degree was I got a real estate license. Didn't know what I was doing. Did a couple transactions, but Dad's advice was get a job with a 401k and a steady paycheck, and so I did that. Kind of bounced around, not really finding any real passion or interest in what I was doing. Fast forward several years. Was actually in an internet marketing job that I enjoyed and I felt competent at, and very unexpectedly, the company I was with decided to shut down our division, and they said, "Have a nice life." I had, before that, I bought my first investment property, a fourplex that I had, lived in and fixed up, and started getting, my feet wet in the rental real estate world, and really had an interest in it, and was finding a passion for that. And so, fortunately, I had some time and space to really figure out what I wanted to do. And what became apparent to me is becoming a commercial real estate mortgage broker was a melding of all of my interests and passions and aspirations for the future. I figured if I could figure out the financing side of commercial real estate, and specifically multifamily at the time, I could figure out how to, it would allow me to invest in that space. And I was relatively clueless. I had a great opportunity to get involved, and I just jumped in with both feet. And so that's what I've been doing full time. And fortunately, through the network and connections that I've made in the business, I've been able to invest. I've been a GP on 5 or 6 deals, and that's a lot of work. I understand firsthand all that goes into it, and I have a lot of empathy and admiration for GPs. For me, I've just kind of set that aside and been an LP investor, but I enjoy that aspect as well. So I'm working in the business, and I'm able to invest on the side, but I think that gives me a good perspective for what I do as far as my day job by actually being an investor and having real skin in the game.
Yeah, and I feel that's rare too. Whether you're a, your type of broker, or real estate commercial broker, lender like yourself, I feel it's rare. Like they don't, the chef's not eating his or her own cooking most of the time. So I think it's important, or it's really beneficial to work with someone like yourself, because you understand it from both sides. Obviously what the lenders are looking for, but you also know what us investors are looking for, because you are one. So if you don't mind just talking about that, how you how you've really been able to work with investors, because you are also an investor yourself.
Yeah, again, it definitely helps to look at it from both sides, and I'm glad that I'm in that mortgage broker space, because really I'm a deal maker, much like the investors that we work with. We kill.
Yeah.
It's a crude analogy, right? But
True.
There's no salary per se. We've got to go create what we're our incomes and our lifestyles, and so that's I feel like just fundamentally interests are aligned, but then debt is such a big part of the capital stack. It's debt financing, it's so ubiquitous. I mean, we're so used to getting loans for cars, homes, investment properties, you name it, there's a loan for it. And so in a sense, we take it for granted. And we just think it's always going to be there, and everything's going to be peachy. And by and large, it is always there. But understanding that that's such an important piece of the capital stack, and getting that right is crucial to the success of the deal. The lender is your biggest investor in the deal, and it can really affect the returns to the GPs and the LPs. So getting it right, trying to find the right leverage, the right terms, prepayment penalties, those sorts of things are just crucial in order to really get the deal structured in a way that's going to optimize returns and produce the best outcomes for people. The prepayment penalty in particular is a conversation that we'll have frequently with investors. And the last couple years, I would say the bulk of acquisition financing has been with bridge loans. Reason being is we were able to push leverage, and there was a lot of that money available and quite cheaply. And as we're facing some headwinds in the capital markets, those the bridge loans are drying up. They're getting more expensive. The leverage isn't there, and so we're starting looking at what are the permanent loan options and lower leverage to make deals work. And you get in a yield maintenance scenario, and it really handcuffs you. So you want to have those conversations and understand the structure of it. What does it look like to unwind it? We're always looking at what it looks like going in. It's easy to brag to your friends about a low interest rate, but what are the implications? And if you're paying 20 bips more, 20 basis points more, 0.2% in a rate, to have so much more flexibility on the back end, because that lower rate by 0.2, 0.25% could cost you hundreds of thousands, and larger deals even millions of dollars on the back end. So you got to think through those things and understand the ramifications of all the terms, not just an interest rate.
Yeah, that's a great point too, because I really do feel a lot of people are so focused on that rate. Like, what are they getting charged? And they forget to think, well, no, this is an investment. So in an investment, there's usually an exit plan. So what is your exit plan? And you have to be looking at terms to see if the terms match your exit plan, because to your point, yield maintenance, defeasance, that can really destroy your return on the back end. If you're paying hundred thousands to millions of dollars in yield maintenance and defeasance, it could blow it up. So I'm glad you brought that up. And furthermore, I think that is one of the many reasons why it's really good to have a relationship with someone like Paul, a mortgage broker who is working for you, has already established all these connections with different types of lenders. Because I know sometimes there's an argument to not go with a Paul and go directly with a lender, but that's not the business I'm in, right? I'm in the business of finding deals, raising money for those deals, and then operating those deals. So I really want to add another level to my business of then going out and building relationships with dozens, if not more, lenders. Why not use a Paul who already has those, relationships, and he's also looking out for your best interest as well. And I just think that's important. And it's why I will personally always use a broker.
There's some subtle nuances there, if you don't mind me.
Yeah, go in.
And again, I'm slanted, but I always try to stay objective and look at both sides of the coin, because a broker really does add a lot of value, or what's the point? But you look at, hey, a typical broker fee is 1% of the loan amount.
Yeah.
And what's interesting is you peel back the layers, and as you're in the business, there's subtle nuances that are really hard to quantify. But for example, even just a local credit union, right? In any market, there's going to be a couple big banks or credit unions that are going to advertise at all the sports venues, and you're going to see commercials, and you may even bank with them. And so that credit union, it's the path of least resistance, and they're going to have their menu of what they can do. There's not much creativity. It's just, hey, this is what it is, and here's what we can get done. But you peel back another layer, and what happens? You call up, say, hey, I've got a property under contract and I need a loan. Well, there's going to be anywhere from 6 to 20 different loan officers. So what are the probability of you finding the best loan officer? And not all loan officers are created equal. I've experienced this. I've worked with with different people in the same institution. And some people are far more experienced. They know how to navigate it. They know how to get things done, get the best terms. Other people can fall down. They can take an extra month. And typically, if you're calling up, you're going to get the person who's not as busy or not as experienced. And, you might be thinking, hey, I'm saving a point, but I've already worked with 5 different loan officers at that lending institution. We know who can get this done in the right way, approved. Another example, and I've done this. You think Fannie Mae and Freddie Mac, again, these are these national programs, and hey, what if I can just go direct to a seller servicer? How these programs are administered is there's a handful of large firms that Fannie and Freddie has designated as seller servicers, and without getting into all the specifics, they're the conduit to Fannie and Freddie for ultimate approval. But Shawn, I've gone out and I've taken the same deal to 5 different seller servicers, and I get different terms back from all of them for the same program.
Not surprised.
And so what's going on? So there's different credit overlays for every seller servicer. There's shared risk, there's implication, there's appetite, there's relationships with Fannie and Freddie. And so again, you never know that. It's a similar scenario. Hey, I'm just going to go to Wells Fargo and go get a Fannie or Freddie loan through them. Well, you might be way more conservative than some other seller servicer, and you might not get the same leverage, or who knows. It's just been kind of eye-opening to see, hey, there's different, for the same program, you can get different terms. And again, there's some value in a mortgage broker who has put in the time and effort to figure out where the best place is to go with those to get the best results.
Yeah, and that's why you need a Paul going to bat for you. So because he has all those connections, and he can, then show you what your best options are. And again, that's why I'll always go through a broker like Paul. Now, Paul, you mentioned earlier that debt is always available to some extent. And if we were to go back a year ago from today, so that would be August of 2021, you could, at that point, debt was available. You could bridge debt, 75% LTV. In some cases, you could even get 100%, or a lot of cases, you get 100% of your CapEx budget financed to, rates that are probably sub 4%. And it was just kind of the wild, wild west in a sense. A lot of deals were getting done at attractive valuations and terms. Now that has changed. What are you seeing in today's market?
Yeah, I wish we could go back and just sell everything we.
Yeah, right.
That would have been a good time. I'm confident in the long-term prospects of the market, but yes, really since the fall and really in 2022, we've seen the market changing. There's been a lot of volatility. There's no surprise in that. I mean, probably most are aware of the Fed raising interest rates and trying to curb inflation and these different monetary policies that are going on. So we've definitely seen a tightening. It usually starts in the bridge market. So the bridge lenders are the first to kind of dry up and get conservative. And we've definitely seen that. So some bridge lenders have just completely exited from the market. Others, again, we're seeing 2, 3, 4% more in interest rates, and 80% leverage is, where that was, as you mentioned, more the norm. Now that's really the exception. And so we're just seeing lower leverage, needing more equity to come into the game. I had a unique scenario on a deal I was working with, and it was a deal in Texas. We were working with a credit union and actually closed loans with this group before. Enjoyed working with them, and midstream, they came to us and said, "Well, we can't do the loan. We don't have any money." And what had happened is they sold off their loans into a secondary market, and that was just how they kept the velocity of capital moving, and that source for buying those loans dried up, and they were just out of the market. And so we were chatting earlier, just the goalposts are changing a lot, and so it's hard to wrap your head around exactly where we are. And I get this question from my clients a lot: where are we? What are we doing? Especially when there's a Fed announcement, and my answer is, I don't exactly know. It's just a moving target. But what I can say is there's still a lot of lenders that are active and want to put capital out there. And I would say currently it's more the exception that this credit union that I talked about that just dried up and says, hey, we're not doing anything. For the most part, lenders are remaining active. The capital markets are strong. It's just a different landscape. You got to plan on putting more equity into the deal, and so that's where creative structures can be beneficial. Maybe creating, like if you're syndicating, well, maybe create your own essential mezzanine loan with a fixed preferred return piece that where you've got a group of investors that isn't sharing in the upside. They get a higher fixed return. They're in a higher position on the capital stack, and you're kind of creating your own mezzanine loan, if you will, to help with the leverage.
But, have you seen that a lot lately?
Yeah, I actually see a lot of, and I see a lot of deals, and that's becoming more and more common. That there's two classes of, two or three potential classes of equity investors. Call it a class A, where it's just, hey, it's a fixed preferred return, 8, 9, 10%. There's no upside, but that's the first equity out, and then there's a more common equity where it's, hey, you're sharing in the upside, a lower preferred return, but it sits behind that, obviously the debt, and then that class A equity investor. So that's I think that's going to become more and more common as we go through this period of uncertainty. If we're looking at the big picture, and here's where it gets a little risky to play a prophet here and say, here's my prediction, because these podcasts live forever. And
yeah, it's true.
The joke I always say about a pro forma is there's one thing we know for sure about the pro forma, and then it's wrong.
It's wrong. Yeah.
That's all we know. It's wrong. We do our best to get as close as we can, but and so I'm probably wrong, but here's what I see in the markets. The monetary policy is happening, right? The Fed has raised interest rates to curb inflation. There's quantitative tightening on the horizon, which really hasn't kicked in, but is about to. And we've had a long run of quantitative easing, and so that quantitative tightening is going to have some implications in the capital markets. So I think things are likely to get worse before they get better. I think we'll continue to see rates where they are, perhaps higher through the rest of 2022 and into 2023. My personal belief is that it is bad politics to be in a recession, and the federal government has a ton of debt that's variable rate, and there's no incentive for them to keep interest rates high because they've got a higher net each month. And so hopefully we get inflation under control, and I anticipate a turning where they're going to be able to lower interest rates and either normalize the quantitative tightening, and who knows exactly what will happen there, but probably some continued headwinds for the next 6 to 12 months, and then again they're not going to want to stay in a recession long term, and they're going to start making some changes. And so really that's such an opportunity for all of us. And so what's going to as rates have crept up, and we see that the cap rates are no longer compressing but expanding, right? And that's really a function of interest rates. And so again, why not be bullish when everyone else is bearish? And why not take advantage of a decline? So it sounds a little perverse in a sense to try to buy at the peak of interest rates, right?
Yeah.
You don't want to lock in yield maintenance, but why not be buying? Again, it's time in market, not necessarily timing the market, but
right.
That way you're taking advantage of all cycles. But if you buy when interest rates are high, your cap rates are going to be the highest, and then as interest rates come down, those cap rates are going to compress. And it's so important to have good operations and be diligent and buy right in this business. But we've benefited for years of cap rates compressing. I believe we're in a period of reset where they're gonna climb back up, and then why not ride that wave down again? And there's so much more value to be created from a cap rate going from a 5 to a 4 than raising rents $100. I mean, it all factors in, right? But that cap rate
that's the biggest lever.
It's fantastic what it can do for us.
Yeah. I really think it's just going to come down to just being able to be creative and flexible in your deal structure. And that's how you're going to get deals done in this time. Because I'm like you should always be buying. As long as you're buying smart, there's, in my opinion, no bad time to buy. And I think it's just going to come down to being creative. And well, actually, I have a question for you. So I've heard this argument, which I tend to agree with, but the argument is that the kind of the band or the range of cap rate expansion and compression, that range historically has been quite large on where it will move. But the argument is that range is going to be smaller now due to a multitude of factors. There's a lot, more money coming to this asset class. It's becoming more mainstream. People are searching for yield. It's not in the bond market anymore. And people are coming to this asset class. And so they feel that, yes, there still will be expansion, but it's just muted compared to what it used to be. Do you agree with that? Or have you even really considered that, I guess, is the right question?
Candidly, I haven't put a lot of thought into it, but as you're talking about it in a roundabout way, I have, and I do agree with what you're saying. And even yesterday, I was chatting with a client about the market and where things are going. And he's like, "Oh, back in the '70s with Paul Volcker, and 17% interest rates, and what if we go there?" And I'm like, "We're not going there. There's no way.
It would cripple
There's
the government."
No way that's happening. We're not in that bad of shape, and it would just cripple everything. And again, I just feel like the government is going to do everything they can to prop it up. There's so much evidence of that. Rates were probably kept lower than they really needed to be. The first sign of any adversity from COVID was just all sorts of stimulus, and we're paying the price now for that. Like I'm all for less government than more. The economist in me believes that there's a lot of inefficiencies when governments get involved and start pulling these levers, but they're going to do it, and I don't think there's anything we can do to prevent that. And it's like I said earlier, it's bad business for government to be in a recession. So I would agree with that statement that the band and range of cap rates it's going to stay tighter for the foreseeable future.
Which is good for us. Like, to your point, let's take advantage of the expansion, even if it's small right now. Still take advantage of it, because when you ride that compression back down, that's where true wealth is made, coupled with raising rents and reducing expenses, obviously. But that cap rate is the big lever that really makes a big change.
That opportunity is on the horizon. Like it takes cojones to get in.
Yeah, it does. And because you don't, like, to your point, it's we're not messiahs here, or have a crystal ball. We can't really predict with any type of certainty as much as we'd like to. But as you look, like, I'm sure you look at the forward curve a lot, and that's been changing. I remember back in March, when they first raised rates, the forward curve was showing that rates would rise until about the end of 23 and then pull back in 24. And last time I looked, albeit that was probably a month ago or so, it was actually pulling back before that now in 2023. So again, you got to take that with a grain of salt. But if that's the case, it's going to be, a shorter run than probably most people are used to in terms of cap rate expansion.
Yeah. I'd agree with that.
So are people still using bridge debt? And if so, what are the caps kind of look like on those, and how are they structuring those?
Yeah, it's still out there. What we're finding is lenders are getting more conservative. And so if you can get a permanent loan at 65%, and you've got a bridge loan at maybe 70%, and you're paying 2-3% more, and you've got this balloon hanging out there, you've got a refi in a couple years. Again, we don't know exactly where that is. It's just the delta, and I think the perceived risk of that is it's just not making the same fiscal sense, or there's just not the same appetite for it. So it's out there, but it's just tightening the difference between what a permanent rate might be, and the bridge loan. And so it's, that in a succinct way, that's the best way to describe it. Some lenders have come out of the market, but again, we work with thousands of lenders across the country. So it's not like we're beholden to a couple that say, hey, we're going to close up shop for a little bit. It's just those terms have changed, and there's more awareness about the risk of that exit from the bridge now. And there's a lot of bridge debt that's been originated over the last 2-3 years, where lenders are holding this and they're getting nervous. Like, how is this investor going to get out of this? Are they going to have to come in with additional equity? Can they do that? Are they going to have to sell? That sort of thing. So it's just a more conservative landscape.
And do you see opportunities stemming from that for people to come in and buy properties, for those that have bridge that bought in the last couple of years that may be forced to sell?
Absolutely. There's no question that that's going to occur. So let's say you're 80% you did an 80% loan to cost, and your costs probably were a little higher than anticipated because of the inflation, right?
Yeah.
So
Yep.
you may be a little out of balance at that. And depending on the bridge loan, if you had a 3-year term with maybe a couple extensions, you have some more runway. But definitely there's going to be there's going to be assets that are coming online that have been syndicated, leveraged to the max because trying to maximize returns. And there's either going to be a need for a capital call or an exit. And depending on that syndicator, general partner, we can make the argument that the right move would be to have a capital call to ride it out, rather than a bit of a fire sale. But there's a lot of pride out there as well.
Yeah. It's tough to do that.
It is tough to make that capital call. And so I think we are going to see, hopefully I won't be getting this email on my investments, but there's definitely going to be, hey, we're selling this deal, we're going to miss returns, but at least we're returning your capital and a few extra dollars. I don't think we're at a point where there's going to be, a lot of foreclosures or that sort of thing. But there are going to be some opportunities and some sellers that are motivated to unwind these deals to avoid that swallowing of the pride for a capital call in order to refinance.
And your experience, kind of when is that decision made? Like if we're looking at, you've got 1 year left on your bridge loan, and when have you kind of seen that decision be made? I'm sure it's probably all over the place, but if there is any commonality there, and does it tend to start from the operator syndicator, or does it tend to start from push from the bank or the lender on what needs to be done?
Yeah. So again, it's across the board and depends on the terms that you set up. And that's again, we talked about this at the first. It's so important to think through your exit, right?
Yeah.
So having some local lenders might do a 12-month construction loan, right? And there'll be some which can be used as a bridge. And so that's just not a lot of time. And most of these local lenders, they don't have an appetite to foreclose. They don't want to take back properties. It's a pain. It's bad for business. They don't want to do that. So there are these extensions, but it becomes this thorn in your side. And then you're paying, typically it's at least a point a year. So, you need 3 months and you're paying that interest, and then you're paying another quarter point every quarter to extend. And at some point they're like, hey, let's move on here. So the best operators are good at executing their business plan in a timely manner. I think that's definitely a factor. If you haven't executed your business plan in a timely manner to get to that stabilization place, you don't have as many options, right? You gotta keep going. You got this pressure to get stabilized or do something. So speed of execution is huge in that front. And then a lot of that decision is going to be based on that loan term and when they have to unravel that. And it's probably too late if you start thinking about it 2-3 months before the end of your term. And we did a lot of bridge loans, and I'm following up with these clients, 3-4 months in advance, saying, hey, let's figure out the game plan so we can make sure you're taken care of in that regard. Always having the eye towards that exit. That's where the money's made in this syndication business, right? The cash flow is great, but the big dollars come on that exit. And so, there's so much conversation. There's coaching programs everywhere about getting in the game, getting in a deal, buying a deal, structuring a deal, but the exit's almost an afterthought, and it shouldn't be. Shouldn't be.
Yeah, and it's sometimes the operations is an afterthought too, which shouldn't be either. It seems like with some of these mentorship programs, it's more of like how to get your first deal, how to get your next deal, but not, well, we actually gotta manage this thing. Which is sad because that's, to your point earlier of always buy right, 100%, but you can buy right and still manage it into the ground. So it's sad that not everyone is getting that type of education, but that's probably a whole other show we could talk about.
Sure.
Have you, or do you see an uptick in loan assumptions? And for those that aren't familiar with that term, just from a very high level, essentially there's the property has existing debt on it, and this lender allows you, the buyer, to assume it. Generally, you're going to have to bring in something called a supplemental or like a second loan to cover the new value of the property, right? So Paul, have you seen an uptick in this, or do you foresee an uptick in loan assumptions?
I may not be the best person to answer that question.
Okay.
My caveat there is any assumptions and any supplementals go directly through the lender or seller servicer. If we're looking at Fannie, Freddie, HUD, wherever that's originated, that's going to be a conversation with that asset management group. And I just don't get involved as a mortgage broker with that. On acquisition deals, I will work with clients that will, look at a deal that there's in-place debt, and it's uncommon that debt structure is optimal for their goals and what they want. Usually it's, with some compression of values, there's still been a ton of appreciation, and it doesn't usually fit the leverage that the clients want or the investors want to have in place. And so I haven't seen necessarily an uptick in that. Perhaps there will be. And then realistically, you may be 1% to 2% different from where rates are now on Fannie and Freddie from something that was originated 3, 4, 5 years ago. And so I think they'll become more compelling if rates do, a typical agency rate's going to be 4.5% to 6%, depending on location and leverage and size and that sort of thing today. If that's up in the 8% range, 7-8% range, I think those assumptions of a 4-5% debt will become more compelling. But where we are now, I just don't. I don't think there's any different appetite in the market from the norm on that.
And the reason I ask, we just had a deal presented to us that has Freddie on it, 3.8% rate. But to your point, that's an amazing rate, right? But the amount of supplemental we have to bring, it just kills, your return.
Yeah, and your supplemental is going to be 6.5%, 7%.
Yeah,
right?
exactly.
So your blended, what is it any better?
The blended's still not terrible, but it's just not there. Because what they want for that deal, what you got to bring, that there still only go so far on the LTV, and then you got to raise all this other capital, and it's just not enough meat on the bone. So there's a lot of factors in play. But yeah, it just made me curious to see if there's other, assumptions going on out there. But I get your point of like, you're dealing with that lender directly because you're assuming their loan. But yeah, I was just curious.
Yeah. Again, if there's a theme here, it's come up several times, but don't handcuff yourself with yield maintenance.
Yeah, exactly. Because with that, you're going to have it.
If you're going to hold it for 5 or 7 years, that's fine. But again, I'll steer people, like you can get historically like the 10-year, right now the 7-year money may be the cheapest on agency, but 7-10 years, that's a long time for yield maintenance.
Yeah, a lot can happen.
Pay a little more. You're going to be grateful down the road to have, a step down or just no prepayment penalty when you want to sell.
Yeah, it's just a good thing to think about is think back to 2021. If you were 5 years into, or let's say 4 years into a 7-year term with a bunch of defeasance, yield maintenance, that would have been the best time to sell in terms of what you could get for the property. But then you just be hammered with yield maintenance, and you're stuck, right? So it definitely does reduce your flexibility, and be able to make a strategic move. So yeah, I think that is the theme of the of the show today, is think of your exit. No, but Paul, I don't want to take too much of your time. This has been great. I've learned a lot. I'm sure the audience has too. But before I ask you the final two questions, where can the listeners find you?
Yeah, I've got a little bit of a tricky last name, so it's pretty unique. It's Winterowd is how we pronounce it. My joke is, I'm not sure if we don't know how to spell or pronounce in my family, but it's one of the two. It looks like Winterowd if you're more phonetic. So it's Winter OWD. But Paul Winterowd, I'm on LinkedIn. That's a great place there. And my email is paul.winterowd, again, WINTEROWD @stacksource.com. And that'd be love to connect on LinkedIn, or if you've got any questions or a deal you want us to look at, we can, email is the best way to get in touch.
And to that point, Paul, I probably should ask this question earlier. Generally, how do you like to work with investors? At what point would you want them, sending you a deal to look at? Obviously, we don't want to waste Paul's time on anything, but I know he has a strategic partner at the same time. But at what point would you want an investor to send you a deal?
Sure. Sooner's better than later, but on the same, because it's helpful to understand some general debt terms. But you can call me or email me, and what I want you to have is obviously a purchase price, an address, know what the occupancy is. If you have a rent roll, if you have a T12, know what your NOI is. What's your general business plan? What's your exit strategy? And I can give you a pretty good idea of where the market is going to be with regards to debt. I'm conservative by nature. There's certainly people in the industry that I compete with that, and not to throw anyone under the bus, but it's more of a, hey, let's tell you the absolute best terms out there, and can we get you excited and get you committed, and then it may not turn out that way, and no one can totally control the market, but I tend to lean towards that more conservative side and say, hey, here's what's realistic. It might not sound entirely sexy on the surface, but I recently changed companies. So this is the first move I made in my 7-year career, and I came over to a company called StackSource. And there's a lot of reasons why people change companies. I was not looking to change. Change came looking for me, which was flattering. However, what initially intrigued me and was ultimately the reason I decided to change is StackSource is really built on a technology platform to provide more transparency to the investor with regards to terms and options, faster results, and also deliver the market. Now that might sound a little obscure, so let me explain that a little bit. We've built a database of over 1,700 lenders and loan programs for all types of asset classes across the country, anything commercial real estate. So whether it's multifamily, industrial, office, hospitality, retail, what have you, we've got lenders that do that. And so and this was the seat I sat in before. A typical mortgage broker is going to be limited to his network, his memory, perhaps a spreadsheet, old emails. What we've got is a database where in real time, and people can go to stacksource.com and plug in information about a deal. And there's about 14 steps that'll go through, say where the deal is, what type it is. You can upload documents, you explain the NOI, those sorts of things. And in real time, it's tied to this lender database, and there's over 100 different fields for every lender in this database. And it will drill down based on desired leverage, location, asset class, and say, hey, you've matched with 23 lenders, or there's 78 lenders that have interest in this. And so we use that technology to push out the right information to these lenders so they all see it in real time. It's not just based on my memory or who I've done a few deals with. And that way we're able to, we feel confident that we can deliver to market. Now, does every lender respond? No. It's not foolproof, but
right.
We're actively following up, and we have this technology to know who the players are for your deal, and we can confidently come back and say, hey, these are the best terms out there. And so I may have got a little sidetracked. I apologize.
No, I'm glad you brought that up. Because I didn't know that either. But that is new, and I like the transparency there. That's cool technology. I'm gonna personally check that out. So stacksource.com.
Yeah, and every time we get a quote from a lender, we enter that onto the platform, and it pushes out an email to you. So you'll see every quote from every lender as soon as they come across.
That's cool.
Our desk. So again, trying to provide more transparency, and so that's why I made the shift. I'm excited about what we can offer, and that's my job to deliver the best terms. And we've also got resources on bigger deals to complete the whole capital stack. We have equity partners that can come in and round that out when you're going to run out of friends and family and you're doing bigger deals. We can help with that as well. So we're continually growing and expanding our database, and it's been great so far.
Oh, that's awesome. Yeah, it's definitely not normal. That type of transparency. Generally, it's you're not getting that term sheet kicked to you per quote, right? It's normally the broker is compiling it and then sharing it with you. And it's not that the broker's hiding anything from you, but to me, it's more the fact that sometimes as an investor, you don't necessarily know what you want all the time. So I could see the benefit of seeing every quote in real time, and then maybe stumbling upon something, realizing, oh, maybe this is something I want in terms of like terms, So I think that's really cool. But as we're talking, I'm realizing I forgot another question to ask you. When you mentioned earlier the type of terms that an investor should be looking for before they send to you, and what comes to mind to me is DCR, so debt coverage ratio, and debt yield. And kind of what is the range? I know it differs per type of debt, but what is kind of the range you're seeing on those two where there's an appetite right now?
Yeah. So as far as full leverage, and there's so many levers to pull.
Yeah, right.
Right. People are like, what's the rate? And it's like, well, let me ask you 13 questions so I can actually give you an answer.
Yeah.
Debt coverage, we're at full leverage, typically on permanent loans, 1.25 is really the norm across the board. A lot of people don't realize, hey, if I can get to 65% leverage and a 1.35 debt cover, there's a whole different world of options there. sometimes that's ignored, but rates get better. There's more interest only available at that. So again, let's say you're sizing it. Sizing is industry lingo, but the loan amount is coming in because of a 1.25 debt coverage at 70% leverage. Well, you may want to look at, hey, what if we get down to 65%? Our rate might go down 30 basis points. We might be able to get full term interest only at this point, and it can change some dynamics, and you're only really reducing it 4 or 5% if you're constrained at that 1.25 debt cover. There's a few out there, a few lenders that I've seen a 1.2 on, but that's not the norm. That's more the exception. And then with debt yield, before I move on, I would say that everyone in commercial real estate should get familiar with the financial calculator. And financial calculators are confusing, but there are apps that can help with this. And I use it every day, and it's really solving for a present value of a deal. But if you can put in a rate, you can. I don't want to be too confusing or complicated, but let's to do it, to figure out what you can, what the loan amount is. If you take your NOI, your trailing 12 NOI, or if you annualize a trailing 3 months or whatever, you divide that by 12, you get a monthly net operating income. And don't forget taxes and insurance and all these things. And then you divide it again by the debt coverage ratio. So you divide that monthly NOI by 1.25, and that's going to give you your maximum payment. So you plug that in your payment field, you plug in a rate and your term, your amortization, so whether it's 25 or 30 years, and then you just click the present value button. That'll tell you what you can qualify for. So hopefully that's not too convoluted. It's a calculation I do multiple times every day, and it's really useful to just get an idea of, hey, what can I qualify for there? Does that make sense, Shawn?
Yeah.
Let me just ask you, does that?
Well, for me, it does. It takes me back to college, learning time value of money in my first finance course, but maybe to some of the listeners it isn't. But I get what you're saying. And I think it is important to do that calculation, not just to see the number, but to actually understand why that's so important and how the different inputs can drastically change an outcome.
Yeah, it's so easy to just say, oh, well, I can get 75% loan to value, and that's the number you have in your head. You start crunching numbers that way, and you're like, it's so rare that we're constrained by like the actual value. It's so much more cash flow, meaning the debt coverage ratio. So luckily this is recorded. You can go back and listen to that and take some notes if you're interested. The debt yield calculation is definitely simpler. It's very similar to a cap rate. It's just from a debt side. So you take your net operating income or your stabilized net operating income, if you're in a bridge scenario, looking at what it'll be once you've executed your business plan, and divide it by the loan amount. And that's going to give you a debt yield. So a cap rate's your NOI divided by value, gives you your cap rate. The debt yield is simply the NOI divided by the amount of debt. And that's going to be higher than the cap rate because it's it's a smaller denominator. But 8.5 is a common number. It could be anywhere from 7 to 9, but in that range is where lenders want to see that debt yield. And again, that's going to that can be a constraint. It's not as it's certainly common, but not as common as debt coverage. Some lenders don't necessarily pay attention to that much, but again, that's another metric that's good to check. And I'd say, hey, you're looking at a deal, you think, hey, I can get this much debt. You plug in your NOI, and if you're getting a 6 debt yield, chances are you're anticipating too big of a loan, or you're just gonna, or you're just not gonna get that in the marketplace. You're looking for a needle in a haystack at that point, rather than living in a more realistic scenario. So, yeah, handy calculations to just be a more sophisticated and informed investor. When you're building out your model, to anticipate some, what your leverage point will be.
Yeah, I think it can help people move on to the next deal if that deal doesn't make sense, right? I think we can waste a lot of time on maybe a deal that just would never really make sense at that given time, at that given price, and kind of help us to move on to the next one. If you're looking at it like a 1.1 DCR, yeah, that's probably not going to work. So unless you can get the seller to drastically drop their price, or you can, lower your LTV, then maybe. But all right, last 2 questions here, Paul. First has 2 parts, and that is why real estate as an investment vehicle to meet your financial goals or anyone's financial goals. And part B is what type of life has it afforded you?
Tough question to be succinct on. To answer the second half first, it has been life-changing for me. Life in general doesn't always turn out the way we expect it. Getting involved in commercial real estate has done more for me financially than I really thought was possible. And that's, you look at 7-8 years of being involved, maybe 8-9 since my first investment property, but it has dramatically changed, my net worth and, my trajectory. And so I'm a big believer in it. Again, I jumped in with both feet on all levels, and the bulk of my portfolio is in commercial real estate, and you try to create some liquidity and have some paper assets and cash, because lenders like that. It's easier to do deals if you have cash. So that's a component. I'm not a believer in 100% commercial real estate, but it really has blessed my life and really changed my life more than I could have anticipated. So if that's not a testimony to get involved, then I don't know what is. It's not necessarily easy or fast, but again, that's a reason why I like it. I've been foolish enough to dabble in cryptocurrencies and options and different trading strategies. Like, look, I mean, it's just gambling. I'm not smart enough to do that stuff successfully. And one thing I love about commercial real estate is just the long-term nature of it. And so you get involved in a deal and it's like, hey, that money's sitting there for 5 years. There's not really access to it. The goal is that it's, for every dollar I give, I'm going to have 2 come back. And sometimes it's better, sometimes it's worse. But if you think about doubling your money every 5 years, start with $1 million, and like 20 years, if you're continuously compounding that, you're just reinvesting it. It's like, it's going to be at least $20 million. I don't have the spreadsheet up in front of me, but it's
a lot of money.
It's pretty amazing what you can do there. And so just the fact that I really like that slower moving. There's no app that I can open up and say, hey, what's my value today? It's like, hey, this is what it is. Real estate in general is very inflation resistant, right? And we know inflation is going to be around one way or another. So great place to be that's in a lot of ways immune to the negative effects of inflation. But really, it's not just real estate. It is a business. And we got to remember that we're investing in a business and a business plan. I have no interest in just if a syndicator came to me and said, hey, well, we're going to buy this real estate and we're just going to let it appreciate, or it's just going to sit there. And, in 5 years, it'd be like, okay, what? I can go get 2% in a savings account now. I mean, or maybe a little better in a cap rate, but you can invest in debt or something, why bother? But there's a business plan component. We invest in real estate because there's opportunity to add value, increase income, and we're not just waiting for the market to do something, right? And there's an immediate control. There's a extreme microeconomic element to a piece of real estate, and a business plan can be executed on that and create immense value, really anywhere, virtually anywhere in the country, if the opportunity is right and that business plan is sound. And it's not typically a super complicated business plan. Again, I'm not smart enough to go build some software or get this complex business. Like it's complicated enough to be meaningful and impactful, but it's simple enough that most people can do it and get involved. There's we won't spend time, but there's great tax advantages to it. The government's in my opinion, a horrible capital allocator, but they're actually a good incentivizer. Housing in particular is a very important part of our lives. It's integral to our being. And so the government has incentivized developers and owners of real estate to keep creating that so there's housing for the population, and we benefit from that as real estate investors. We have to pay the government less because we're doing that, because they need that done. So again, so much for being succinct. There's so many great reasons to be in commercial real estate. It's not my phrase. I think I've stole it from the real estate guys, but it's not a get rich quick, but it's a get rich for sure investment strategy.
I couldn't have said it better. Great answer. All right, last one. Since this is also a personal finance show on Fridays, if you had a time machine, you could go back in time, talk to younger Paul, and give him one piece of financial advice, what would that be?
Pay yourself first.
It's a good book too. Profit First.
Yeah. I think it stems from Richest Man in Babylon.
That too. Yes. Yeah.
That idea of, whether it's 10% or more, but the general premise, if you're not familiar with it, is, for anyone not familiar with it listening, is you get your paycheck, you get your income, and you say, okay, I've got all these bills and obligations, but I'm going to take 10% and I'm going to invest in me. And you start setting this money aside and you never touch it. And you build it up and you invest and you learn about investing, you invest wisely, and you just let that compound and grow. And eventually it gets to the point where that will kick off enough cash flow to enable you to live your life. Again, it's not something that happens quickly, but you do that for 10 years and you'll be amazed at what happens. And then, eventually you get to the point where you have that choice. Do you continue to work that job or what you're doing because you've got this nest egg that you don't have to cannibalize to live? It's not about, I love my dad. His retirement strategy was, I'm going to save enough that I can retire at this point and not have enough money to withdraw and live on it till I'm 85. And I'm like, well, Dad, what if you live to 92? It's like, well, it's a good thing you're in commercial real estate, Paul, so you can take care of me. I don't like that. I mean, I will, but I don't love that strategy. I want a nest egg that's going to facilitate my lifestyle and I'm a believer in giving. I try to give more every year, and that's not saying I'm better than anyone, but hopefully that nest egg can be used to do good in the world. When I finish this round of life, and someone good causes can benefit from that at that point, and we'll see what happens, but pay yourself first.
Yeah, I love it. Well, Paul, thank you so much for your time today. Really appreciate it. You definitely.
Yeah, I really enjoyed it.
Yeah, you brought the heat today, so we did that. That was a fun one. So yeah, thank you. And to the listeners, as I always say, easy doesn't pay well, and instant gratification is self-destructive. So get out there and not only work hard for your money, but have your money work hard for you, so you can create the life of your dreams. And as Paul mentioned, then we can give back to the world and make it a better place. All right, catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.